The design of a credit limit feels normal, but it is rarely accidental, and the structure behind it changes everything. Most consumers perceive their credit limit as a protective guardrail. The assumption is that a lender looks at your income and debt, then runs the math to define a ceiling you can reasonably afford. This view is rooted in historical underwriting, where human experts assigned fixed limits to keep borrowers from overspending and protect the bank from default. Modern financial institutions have replaced that passive safety net with a fluid instrument of financial engineering. The number assigned to an account is a dynamic variable, a specific figure calculated by analytical models to shift in response to your behavior. To see how that variable moves, we have to look at who is actually asking for more credit. In the United States, roughly 4 out of every 5 credit limit increases are proactively initiated by the bank. These algorithmic decisions analyze your transaction data to target revolvers, the customers who generate interest revenue by carrying a balance from month to month. This chart shows a low and grow strategy. For subprime borrowers, lenders start with a tight limit, averaging only $700. If that borrower maintains a revolving balance, the limit scales aggressively. 5 years later, that account averages a $2,700 limit, a 285% increase. By automating these increases, banks expand the capacity for debt exactly where it is most profitable, without requiring the consumer's active consent. These algorithmic increases are effective because they exploit a cognitive bias known as anchoring. An unprompted limit increase shifts your psychological anchor. It subtly recalibrates your internal sense of financial flexibility, making a higher level of spending feel safe or normal. This shift combines with payment decoupling, where the delay between swiping a card and paying the statement masks the psychological pain of the purchase. This diagram represents the empirical outcome documented by the Federal Reserve. When a limit rises, debt tends to rise with it. Consumers consistently increase their revolving balances to consume roughly 30% of that newly created credit threshold. Algorithms don't wait for your financial needs to change. They proactively alter the limit to trigger a change in your spending. This behavioral cycle is reinforced by a systemic feedback loop, the interchange fees collected from merchants every time a card is used. These fees fund the rewards programs that create a reverse Robin Hood effect. The high interest and fees paid by lower-income revolvers effectively subsidize the cash back and miles earned by high-income transactors who pay no interest. This visualization shows the scale of that redistribution. Research estimates an aggregate annual transfer of $15 billion moving from poorer demographics to richer ones through the credit reward system. The net result is a massive aggregate transfer, using the interest and fees of those in debt to fund the perks of those who aren't. There is one final forcing function behind these limits: international banking regulations, specifically the Basel III rules. These rules include a 10% credit conversion factor. This requires banks to hold reserve capital against the unused portions of your credit line. Because unused limits are now expensive for a bank to maintain, they are structurally incentivized to cut limits for low utilizers while pushing higher limits onto the revolvers who will actually use them. So the effect is not random, it is structural. And now you see it a little more clearly. The credit limit is not a personalized safety measure. It is a tool of capital efficiency that shapes household debt across the nation to satisfy the formulas of international banking.